This video is called Trump's Tariffs Will Make Millionaires in 2025, and here's how.
President's tariffs. What is setting up to be the worst day for U.S. equity markets since at least the onset of the pandemic.
Millionaires are made when the stock market crashes, and the bigger the crash, the bigger the opportunity, especially if we can be greedy when others are fearful. That's the best way to get rich without getting lucky. So in this video, I'll cover everything you need to know about the market crashing and which stocks could win big as a result. Your time is valuable, so let's get right into it. First things first, I'm not here to hold you hostage, so here's everything I'm going to talk about. Why this latest round of tariffs caused such a big market crash, how far stocks could drop and for how long, exactly how to be greedy when others are being fearful, and of course, which stocks I'm buying as prices continue to tank. This is a once-in-a-lifetime opportunity, so strap in and let's talk about this market crash. Stock markets around the world are crashing as President Trump's tariffs take effect. Both the S&P 500 and the Nasdaq saw their biggest drawdowns since the pandemic after reciprocal tariffs were announced for nearly every country on the planet. The reason that markets are crashing is these reciprocal tariff rates came in much higher than expected. For example, goods imported from China to the US now have a 34% tariff on top of the existing 20%. Imports from the EU now have 20% tariffs, and Southeast Asian countries like Vietnam and Cambodia got slapped with massive 46 to 49% tariffs. China and the EU accounted for about a quarter of all US imports last year, and we also get a lot of things from Southeast Asia, like textiles, machinery, and electronic components. The big thing to understand is that these reciprocal tariffs are part of a much bigger economic plan. A plan that I personally think is going to backfire, which affects how I'm personally investing. Just to be clear, this isn't about personal politics, and I'm going to back up everything I say with numbers. Let's cover the plan first, and then talk about its potential impacts on the stock market. Trump's economic plan is heavily inspired by a paper called A User's Guide to Restructuring the Global Trading System by Stephen Moran, who's the current chair of the White House Council of Economic Advisors. I'm obviously not an expert on global economics, but I did sit down and read the whole paper to try and get a sense of the big picture. Moran's paper has three key parts: using tariffs as a negotiating tool, forcing fair trade through separate reciprocal tariffs, and ultimately restructuring the US's foreign debts. And we're already in part 2 of this plan. The first part is using tariffs as a tool to pressure other countries into renegotiating trade deals. Like I said in my previous videos, the 25% tariffs on Canada and Mexico were negotiating tactics to address US trade deficits and issues around immigration and border security. The big idea of this part of the plan is to create enough economic pain for other countries to force them to the negotiating table. Part 2 is leveling the economic playing field with reciprocal tariffs, which is what happened earlier this week. Reciprocal tariffs mean that if a country imposes 20% tariffs on US steel, we automatically impose 20% tariffs on their steel as well. So it's kind of like mutually assured destruction, where the only logical conclusion is for everybody to start lowering tariffs and trade barriers, which ultimately levels the playing field for American manufacturers and workers. The third part of the plan is all about weakening the US dollar without risking its status as the world's reserve currency, which also helps make US exports cheaper and US labor more competitive. Now let's talk about why I think this plan is going to fail. Remember what I said earlier. Markets are currently crashing because reciprocal tariffs came in much higher than expected. But how can that be if they're just the same rates that those countries are already charging us? Well, it turns out that instead of actually being reciprocal, the tariff rates announced last week appear to follow a simple formula that has nothing to do with other countries' tariffs at all. They just take the US trade deficit with that country and divide it by that country's total exports to the US to get the number in the middle column of Trump's reciprocal tariffs table. Then you just divide that number by 2 to get the discounted reciprocal tariff rates in column 3. For example, America's trade deficit with China was $295.4 billion, and the US imported $439 billion worth of Chinese goods in 2024. 295.4 divided by 439 is 67.3%, and dividing that number by 2 gives us the 34% reciprocal tariff rate. There's nothing in there about the specific tariffs on Chinese steel, or cars, or electronic components. It's simply the bigger the deficit, the bigger the tariff. Another big problem is inconsistencies from country to country. According to the formula I just showed you, the US would have to have around a 10% trade deficit with the UK to make this math work out. But we actually had a $12 billion trade surplus with them last year, which means the UK already buys more from the US than we do from them, and the Trump administration is still charging them a 10% tariff. There are 115 countries on this list with that same 10% tariff, and all 115 of them are countries that buy more from the US than they sell to us, and all 115 of them just got hit with a 10% tariff anyway. And since nothing in this formula is actually a reciprocal tariff, there's no way for other countries to even calculate how to lower their tariffs in response. That's why these tariffs can't last, especially once huge US trade partners start imposing actually reciprocal tariffs based on the ones the US just announced. For example, just as I'm recording this, China announced 34% tariffs on all US goods, and it wouldn't surprise me to see more countries follow suit. Remember, tariffs on US goods work the same way. They lead to lower demand, which lowers sales for US companies, which leads to lower stock prices. That's the big connection between tariffs and the stock market crash. And that's why it's so important to diversify your investments with assets that don't correlate to the stock market. The problem is that most alternative assets either have high minimums, like private equity, or they're high risk, like cryptocurrencies. That's where the Fundrise flagship real estate fund, who's making this video possible, can help you. They give you access to.
We're going to skip through this ad here. But I don't have much to say when he's explaining the tariffs, so I don't mind just listening and learning.
To invest in some of starting at 10 states. Multiple investments will eventually. I don't think these tariffs will last very long, which means all the pressure they're putting on stock prices will eventually go the other way. But how long could eventually be? And how far can stocks fall in the meantime? To answer that, let's look at some historic market data next. This is a chart from First Trust and Bloomberg showing the S&P 500's performance during every bull and bear market going back to World War II. The x-axis is time, and the y-axis is total returns. It turns out that bull markets last an average of 4.3 years, while bear markets last 11 months. And the average return during a bull market is 150%, while bear markets lose roughly 32% on average.
Okay, so here I'll make some interjections here. Now, I assume, and you know what happens when you assume, that this is based on the S&P 500 versus, S&P 500 index. Okay, that's what I was looking for. So these are based on S&P 500 returns, right? And that's because when we look at the market, let's change this to let's do monthly candles, right? The market has always recovered. We know this. It has always recovered since the history of time. Okay, we know this. But let's change this to something to Cisco Systems. I think it's CSCO. Yeah. Cisco Systems is a perfect example of why we can't apply the same, and I'm not saying that he is, but a lot of people will apply the same logic to individual stocks. So Cisco peaked in February of 2000 on the dot-com bubble. And if we draw a line from the top of this, when did it actually get? It's not. I thought it had. It has yet to recover in 25 years from this high right here. But even if we go from this high in October of 2007, this high took 10 years from December 07 to December 17, right? 10 years to recover. And we can apply the same logic to all kinds of different stocks, right? Like Meta right here. This happened in September of 21. Took until January of 24. Can you believe Meta stock from September 21 until January 24? It took that long to recover. You could look at let's look at AMD, right? This peak over here went from November of 21, took until January 24. So what was that? Most of 3 years. And now it's coming back down. A lot of people are saying, oh, okay, now's the time to be buying the dip because it's only going to be, how many months is this? 1 month, 9 months, 2 months, 1.1 years, 1.5 years, right? So basically, if you buy the dip, you're going to be up in the span of a few months, is what they're trying to tell you out here on the internet. And I'm not saying that's what he's saying just yet. But that's not the case on individual stocks as it is on the market. The market reacts very differently than individual stocks, right? And that's why when the market goes down, all the other stocks get pulled down with it. We like to show this very frequently. 40% of your stock's move is due to the market. 30% is due to the sector, and only 30% due to the stock itself. And the old adage is a rising tide lifts all ships, but a falling tide shows who's swimming naked. And a lot of people have been swimming with their butt cheeks flying out in the winds the last few weeks. And now they're getting stuck. They're getting stuck. And they're like, oh my gosh, what am I supposed to do? And this also goes back to the market cycle, right? If we go back to the market cycle, we can see here, right? This can take ages to go down, and then it can take ages to go across, right? This is from, I don't know what chart this actually references. It could be Cisco that we just looked at a minute ago. But I mean, look, it came down, it peaked in 2000, 2001, finally hit the bottom near the beginning of 2002 and was down there for years. So, to this point, the market can recover a lot faster than individual stocks can. But if you're watching these YouTube gurus who are telling you, oh, you got to buy the dip in the stock or that stock, it's very different than buying the dip in the market because the market's resilient, where individual stocks can take ages. And I don't want to have my money locked up for ages before I'm just starting to get to profitability. I want to be profitable from day one and then move on to the next stock.
War 2. The x-axis is time, and the y-axis is total returns. It turns out that bull markets last an average of 4.3 years, while bear markets last 11 months. And the average return during a bull market is 150%, while bear markets lose roughly 32% on average. That means bull markets last 4.5 times longer than bear markets, and return 3 times more than bear markets drop. This is why millionaires get made during stock market crashes. They're really opportunities to buy the best stocks at the biggest discounts. That's also why I focus on long-term investing. It takes years for markets to hit the top and recover from their bottoms. And to understand that, let's look at another study that splits bear markets into 2 parts, their declines and their recoveries. In 1956, the S&P 500 went down 21% over 15 months, and then took another 11 months to recover from the bottom. Compare that to the start of the pandemic, where the market dropped 34% in just 1 month, and it also only took 5 months to recover. There's an important lesson in this study that I think will make millionaires as well. The average bear market takes around 13 months to bottom, and another 24 months to recover. And even the shortest bear market lasts months, not minutes. That means there's always plenty of time to plan, build cash, and prepare to be greedy when others are being fearful. That's how real money gets made in the stock market. But how do we actually know when to be fearful and when to be greedy? Let me show you that next. Before I even check my favorite stocks, I always check CNN's Fear and Greed Index, which is currently showing extreme fear.
Okay, so let's compare that to Outliers, Fear and Greed real quick. Let's compare that to that. So we're going to go the SPY. Now you'll see that the SPY is sitting on a buy signal. Now this is not a buy to go long. This was really a buy to cover your shorts. And of course, this is before these big tariff announcements came, and nobody can predict that kind of stuff. So currently we're sitting at 33 on the Fear and Greed Index, 33. So that's really not an extreme fear for us. And let's see what that looks like over here. We're sitting actually around, that was the wrong button. Sitting around 33 on the Fear and Greed right now. So a little bit of divergence between what CNN's showing us versus what Outliers showing us as well. Just thought I'd mention it. I thought it was interesting.
This is one of the lowest ratings I've ever seen for this index. And if we look at a 1-year timeline, the market is the most fearful it's been in the last year, which is useful info for anyone who wants to be greedy when others are being.
But that doesn't mean that this is the time to buy as it's going down. It's like it's akin to jumping off a cliff and saying the water's coming at some point. The water's coming. The water. What the. And you're still falling. You're like, the water's going to come at some point, right? So I really like to do this side by side. You've seen me do it a couple times already. We're going to look at the SPY on daily candles. Perfect. We're going to look at the SPY. The right side is today. And on the left side, we're going to look at the COVID drop, right? The COVID drop where the SPY dropped 35% and then started to recover. So from peak to trough, it was down 35.36%. And then from peak to trough so far over here, we're down, come on, clickies, 17%. So where was that 17% on this dip on this side? So if we're at 17%, about right here, right? So what I'm trying to tell you is that while this big drop is happening, this may only be halfway. It may only be halfway. And I'm not saying that this is going to drop twice as far, all right? But what I am saying is that people who bought down here then continue to lose twice as much as what's already been lost. Now, did it recover? Yeah. And not all recoveries are instant like this. Not all recoveries are a V-shaped recovery. But imagine you could still buy the stock. Let's say you bought it at 284 right here. You could buy it when it's coming back up, right? Yeah, actually right there. Your 10 is over your 20, price is over the 50, right around that point right there. In fact, we could throw a green light on it. So your outlier trend template had reversed and you got a green light with the close over the 50 right there, and it continued on. Now, of course, you might make a buck or lose a buck in the meantime. But You didn't have to stress. You didn't have to worry. You didn't have to think, oh man, did I make the wrong decision for weeks before it came back. You could have just got in right as it's starting its new bullish trend, and it went on from there, right? This is the difference here. This is what's going to separate you from everybody else, from people who are buying the dip and they don't know how much further down it can go, where the market's already down 17%. They don't know how much further down it can go. Or you can sit and you can wait and you can have patience when stocks are crashing back up versus when stocks are crashing back down, and you will be to profitability so much faster. And at the end of the day, that's what we want. We want to get to profitability so much faster.
Fearful. The reason I check the Fear and Greed Index first is because it's an average of 7 very useful market indicators, like stock price momentum, strength and breadth, the current ratio of puts to call options, and market volatility, as well as the relative demand between stocks and bonds. So I get a lot of high-level market information all on one page. Two of the metrics that I use the most are market momentum and volatility. Market momentum compares the S&P 500 to its 125-day moving average. There are around 250 trading days a year, so this is really the S&P's 6-month moving average, and the separation between the current price and its 6-month average tells you roughly how much momentum the market has and in which direction. So right now, there's a lot of downward pressure on the market from these tariffs. So my plan is to keep building cash until that pressure starts to reverse. The price doesn't need to get back above the 6-month moving average, but I try not.
Okay, so building cash until the momentum starts to reverse. This I can get behind. This I can get behind so much.
Not to dollar cost average in too heavy until I'm confident that I'm not working against the rest of the market, which means the price should be trending upwards.
Now we're talking. Finally. Okay, I thought this was going to be one of those YouTube channels where it's like, buy the dip as it's going down because it has to go up from here, right? But finally, somebody's speaking some common sense. I like this. So far, I'm okay. I'm on board. I like it.
VIX is the S&P 500's volatility index, which measures how much prices are expected to move up and down based on.
And I do want to point out, right? The VIX is very, very cyclical. Anytime you see these big spikes like this, it's almost immediately monkey hammered right back down. Let's go look at this. So the VIX looks like it's going to open around $48 today. And this shows the volatility. And now throwing order blocks on here is kind of a misnomer. Actually, let's turn off the order blocks. It'll be a bit easier to see. And then let's go to the daily, not the daily, the monthly charts. This should be like giant spikes right back up and right back down. Yeah. So this is exciting because this tells you how many people are basically out there buying puts. How many people are buying puts, and then how worthless those puts turn into in just a hot minute. And yeah, this spiking like this, I don't know. I'm not saying that we're going to crash right back up like we've crashed back down, but these type of moves are usually reversed pretty hard the other direction. But I could be wrong, right? I don't counter trend trade. I'd never recommend anybody counter trend trade. But these spikes usually get hammered back down really quick on the VIX.
On options contracts over the next 30 days, which means this is a forward-looking indicator. The VIX usually drops when the market is moving up, and it skyrockets when stocks start to crash. That means its 50-day moving average tends to be lower in bull markets, higher in bear markets, and has huge spikes that signal extreme fear. So when the VIX stabilizes after a big spike and market momentum starts trending toward or above its average, that's when I start buying more aggressively. All right, so far we've covered why tariffs cause stocks to crash, looked at how long crashes take to recover, and found a way to tell when the market is being greedy or fearful. Now with all that context, we can talk about which stocks to buy as a result. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to make more content like this. Thanks, and with that out of the way, let's get into the stocks. In my opinion, every great long-term portfolio starts with a fund, especially if this is your first market crash or you just want to play it safe. Everything we've looked at so far tracks the S&P 500, but it applies just as much to the NASDAQ 100 since they have so many stocks in common. But the NASDAQ only has 100 companies instead of 500, so it makes higher highs in bull markets and lower lows in bear markets, which is exactly what we're looking for to buy low while others are panic selling. One of the big challenges with tariffs is that increased prices often get passed on to consumers. A study from the National Bureau of Economic Research found that the costs of President Trump's trade war in 2018 were passed entirely onto importers and consumers. Rising prices means lower spending, which means lower earnings for companies and ultimately lower stock prices. That means companies advertising or selling things directly to consumers are especially sensitive to tariffs. But that also means they have the most upside if you believe these tariffs won't stick. On the advertising side, Google is trading at a price to earnings ratio of 18, which is the lowest PE ratio it's seen in 2 years, and the second lowest in over 10 years. The only time Google was trading cheaper than this was at the end of 2020.
I assume he's about to say buy Google. Let's go look at Google real quick. Oh my gosh. Yeah, you're right. This is the lowest price in a hot minute since May of 2024. And you know what? It's had a bit of support at this area right here. Could it go back up? It might. It just might. But in the meantime, while it's screaming downward, this is not the time to be buying it. This is not the time. Wait for your outlier trend template to flip with the 10 over the 20, price over the 50, like it did over here, right? Like it did over here. Now, like I say, you might lose a buck or make a buck, but at least you'll be on the right side of the trend when the trends start going, right? This is what you want to be buying, not this over here. So let's see what he has to say.
22. And according to discounted cash flow models like Simply Wall Street's, Google is currently 43% undervalued. Said another way, Google stock would have to go up 77% to hit its fair value today. That's a 77% upside. Like I said, millionaires are made when the stock market crashes, and now you can see why. On top of that, I think Google's earnings estimates tend to be on the low side. Analysts expect 10% earnings growth, but Google's earnings grew by 36% last year and 27% the year before that. Likewise, DCF models calculate the fair value for Meta platforms at a whopping $880 per share, making it 43% undervalued today and giving it a 75% upside. And again, that assumes 10% earnings growth, while they've actually been growing by more than double that ever since they stopped burning so much money on the metaverse. Another area of the market that's crashing hard is semiconductors, a very big focus of my channel. The Taiwan Semiconductor Manufacturing Company, or TSMC, makes 90% of all advanced chips on Earth, including Apple's A-series and M-series chips for iPhones and MacBooks, Tesla's chips for full self-driving, and of course, NVIDIA's GPUs. President Trump issued a warning that tariffs on foreign chip makers are starting very soon, and they could hit 25% or higher. Like I've been saying though, I think this is more of a tactic to pressure TSMC into building more factories and chips on US soil, as opposed to a serious long-term tariff. We'll see how things play out over the coming months, but today, these headlines are driving TSM stock down to under $150 per share, while fair value is calculated closer to $225. That implies a 50%.
Okay, so this, I am a staunch opponent of fair value. Fair value today is what you can sell or buy the price of the stock for today, which TSMC, as of this very moment, is at 135. I would assume that's the fair value. And I say fair value because what can I buy it for today? To transact that price today, what is the fair value? 135. Right. Objectively speaking. But by assigning your own, quote, fair value, assigning your own target price, you can get emotionally locked into a target price like this that may never happen. I mean, TSMC may potentially never get back up to that point. Can it? Yeah, it probably can. But there is a possibility that it will never reach this point. And if you're holding on to it saying, oh, I bought it at 135 and the fair value is 226, therefore, I have a 35% upside to this stock. But what happens if you're down 35% on the stock, right? What happens if instead of going up to that, you're actually down 40% in this case? Are you just cool with that? Like, assigning these type of values, in my opinion, is a very detrimental way to invest or trade because we don't know where that's going to go, right? And then also, let's say it does come up to that point. Are you going to say, okay, I'm out? No, of course not. You're going to be sitting and holding it, and you're going to say, just how much further can this fair value go? How much higher can my fair value be? Let's do this thing. We got rocket ships to the moon. So, yeah, I don't like that. I would say focus on one thing. Focus on one thing. Focus on what the price is today. And one of my mentors, Minervini, would say, I'm not, wait. Those who ask me where the market will be in a year, or what the S&P 500 will bottom at, totally misunderstand what it takes to be a great trader. I'm in the business of responding, not prediction. Telling the future is impossible and unnecessary. Trading is a now business, right? We don't know what the future price will be. So we can only see what's happening today. And today, the price is trending down. And we'll have to see if it will ever go back up. If it ever does go back up, we can buy. We can buy as it's crashing up. But to buy as it's crashing down, actually, something else Minervini would say, there's no shame in losing money on a stock. But to hold on to a loss and let it get bigger and bigger, or even worse, to buy more is amateurish and self-destructive. So hopefully he goes back to saying, holding cash until things start to reverse, because I agree with that point fully. But I really don't like anybody assigning a fair value or a price target or anything like that, because, anchoring yourself to any price target has really bad emotional consequences on both sides.
Percent upside. The last company on my list is Nvidia itself, because it's trading at a PE ratio of 32. The last time it traded at a PE ratio this low was in 2019, when it was under $5 per share after adjusting for stock splits. Models calculate Nvidia as being 20% undervalued, but I actually think it has way more than a 25% upside in the years to come, and I've made many videos explaining why. But hopefully this video helped you understand what's causing the stock market crash, how long this crash could last, how to be greedy when others are fearful, and of course, give you some great stocks to think about once all this dust settles. Because relying on data instead of your gut is a great way to get rich without getting lucky. And if you want to see what else I'm buying to get rich without getting lucky.
So yeah, like he just said, hopefully, and that's what he means, is waiting for the market to settle down. How can you tell when the market's settled down? How can you tell which direction the trend is? I tell you this all the time. I've already said it several times in here. It's you take the 10-period moving average, your 10 EMA over the 20 EMA, price over the 50 EMA. When those are all lined up, we don't know the date that will happen, but we can be able to tell when it does happen. When it does happen. Right, there's a couple of names I just see in the chat right now. Nvidia's at $88 right now. Yeah, somebody's looking at this today and they're saying, "Oh my gosh, Nvidia $88. What a buy. I should buy it at this point. It's such a great deal," right? $88. We haven't been at that price since May of 2024. And there's other people like you smart outliers out there who are saying, "Ooh, yikes, yeah. I definitely would have sold out of it around 132." And it's down 35% since then. AMD may be going under $80 here. It's at $80.43. And this is one I've been telling you for months to avoid. Months and months and months. And this is exactly the same stock that over and over and over you hear the YouTubers saying, "You got to buy this stock. It can't go lower from here. It can't go any lower." Yikes. Yeah, pretty ugly. SPY's down nearly 4% again this morning. So now that puts it down 20%. Yeah, over 20% at this point. Super great. No, not super great at all. Do want to say shout out to my father who left a comment. Let me say hi to Odie Yule. There he is, the man, the myth, the legend himself. Odie Yule, good morning. How you doing? Thank you for leaving a comment. Shane says, "Thanks to Outlier, I got out of AMD at 116. AMD is at the bottom again and again and again, and it has to go up from here, right? It should only go up from here. It should only go up from here." Some YouTubers are probably feeling great because you got to buy these dips, baby. You got to be flipping my flapjacks. Here's the thing. You don't have to be buying any dips. You don't have to be buying any dips all the way down. No, sir, no, ma'am. But let's do this. Let me introduce myself because I'm just a random guy on the internet. My name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. But let's go see what the market's telling us, right? We see right now the market is clearly not up for debate in a very ugly downtrend. A very ugly downtrend. So this is not the time to be buying. Not the time to be buying at all. And we talked earlier about in Outlier, we see that it's sitting around 33% on the fear, which is certainly fearful, but not like all out ultra fear, which is interesting because I don't know how much more fearful we can get. But in the meantime, we're not going to be running to jump into this market anytime soon. I do want to see over here on the bull list two buy signals today on the bull list versus 126 sell signals today. So the 2 buy signals today were Treehouse Foods and Stone Co. versus 126 sell signals like BRF, like Calumet Inc., like this is ConocoPhillips, like Dole Brands, like Griffin Corp., like HDFC Bank, etc. All of them. Like this, everything is telling you, do not buy. Like we can go look over at Market Breadth. Market Breadth is tanking hard and fast. We can see we did get the crossover just yesterday right here. So for me, I'm not looking to buy anything right now, especially because the market is absolutely getting monkey hammered. But I am very, very, very excited for the Outlier 3.0 release that's coming out really soon. So I need you to go over to outlierdeal.com so you can get entered to win this right here. Like I say, $1,000 and a free year of Outlier, a $200 swag pack plus my 5-book bundle, or a $150 swag pack plus the 5-book bundle for the first and second runners up. And of course, don't forget today's secret code. Today's secret code is, where's it at? Where's my secret codes? Today's secret code is Outlier. Today's secret code is Outlier. So be sure you come to this afternoon's live stream where outliers like us will save time, make money, and start winning with less risk together as a team. And of course, YouTube is going to pop up a couple recommended videos. I recommend you watch one of them, and I recommend you have a great day. We'll talk soon. I'll see you this afternoon.